Okay. Hello, everyone. Welcome to live virtual revisionary classes from the Institute. Today, we have a very specific topic when it comes to the revisionary classes. So we will be starting up with this topic on transfer pricing, and then we will go into the topic of advance rulings. So what I have, before I actually get started, I am Kriti Chawla, and I will be taking up, this particular session. Um, these are, the topics that I have allocated for today. So we will be talking about transfer pricing in a lot of detail, and then we will go into a topic which is relatively small, which is called as advance rulings. Now, when it comes to transfer pricing, we will start with an overview of, transfer pricing. I will tell you what transfer pricing is all about. I do understand that this is the time, you might be in revisionary mode, and this is something which is very basic, but nevertheless, I'd just like to allocate a few minutes to understanding what exactly is transfer pricing. And then we will go into technical topics like what are associated enterprises, what is international transaction. We'll go into other technical topics like what are transfer pricing methods and documentation, safe harbor rules, APAs, secondary adjustment, and limitation of interest deduction rules. So these are all the topics that have been provided in the manual also, and these are the topics that we will be, touching upon. Now, how I will actually be doing this particular lecture is that I will take you through the topic like I have topics like let's say associated enterprise. So I will just talk about the entire topic in a lot of detail through these particular slides. I will also talk about and I will give you a lot of examples on these particular topics, like the examples that you can see on the screen. And then what I have done is I have picked up questions from past papers. So this is a question that came in, for November 2018, and we will be talking about, these particular, questions also. So this is how I have, tried to put in all the topics. So just to give you an idea, we'll be talking about the topic. We will be, discussing examples, and then I will be taking up questions, on that particular topic, questions from, past papers. So this is how I have structured all the, topics for today. After transfer pricing, we will be also touching upon advance rulings. Again, for advance ruling also, I will be taking you through the entire topic, and then we will be talking about, some questions on advance ruling as well. So this is how I have, allocated everything. Um, let's get started with the topic on transfer pricing. But before that, if you have any questions with respect to any topic relating to transfer pricing or advance ruling, whether or not I have covered the topic in these particular in this particular presentation or not, just feel free to put the topic in the chat box, or obviously you can put it on the portal as well. I will be checking the portal from time and again, so you can just feel free to put it on the portal, or just feel free to put it on the chat box also. So this is the slide that talks about the basic of transfer pricing. Why did transfer pricing come into place? This was actually the problem with intragroup transactions. I'm sure you know what are intragroup transactions. Intragroup transactions are transactions between associated enterprises. So what is the problem with these particular transactions? The problem is that, when unrelated parties they transact, these transactions between unrelated parties or between independent parties, they are driven by market forces. What do I mean by market forces? Well, they are driven by demand and supply mechanisms, as in they're conducted at open market price. You know, things like the seller would always want to sell at the highest price possible, and the buyer would always want to procure something or purchase something at the lowest price possible. So with this interaction, they come up to something called as an open market price. But then the point is that when associated enterprises they transact, or when related parties transact, related parties like, like a parent company and a subsidiary company, or two subsidiary companies in a multinational group, when these parties they transact, they do not necessarily transact at open market price. So then what do they transact at? Well, they transact at a price which is not governed by market forces. They transact at a price which is the which is driven by common interest. It is a manipulated transfer price that they actually transact at. This price is not governed by market forces, as in it's just occurring because of the relationship that exists between them. They just come up with a price, and then that is the price that they actually transact at. And this actually creates a problem, which we will talk about today. This problem leads to something called as tax avoidance situation. And that's the reason they came up with transfer pricing. So I'll give you an example. This is one of the examples. Let's look at situation one, which is on the left hand side of your screen. Now, let's talk about a company in India. And this particular company in India is actually manufacturing something. Let's say they're manufacturing pens, and they are selling it to an overseas company. Now, these two enterprises, which is the company in India and the company outside India, they are not related to each other. What do I mean when they're not related to each other? Well, they're just random independent enterprises. So, what they do is the cost of manufacturing this product for the Indian company is 60 rupees. They sell or they decide to sell this product at 120 rupees. The profit comes to 60 and tax at the rate of 30%. Let's just presume that is 18 rupees. Tax at the rate of 30% on profit of 60 becomes 18 rupees. So 18 is the tax that they're actually paying. Now, the question is, Kriti, how did you get sales at the rate of 120 rupees? Well, this sales value is, the market price. This is driven by market forces. If you see other people in the industry, they will also be selling around 120 because this is the, demand and supply mechanisms, and this is the open market price. Now, let's look at another situation, which is the same thing, exactly same thing, but just the difference is that now the parties are related to each other. So this company in India is the parent company, and now they are actually selling it to an overseas subsidiary. Not an overseas company, they are selling it to their own subsidiary out here. So this is the parent company and they're selling it to an overseas, subsidiary, and they are related to each other. Now the cost remains the same of manufacturing this pen at the rate of 60 rupees. Sales is at the rate of 80 rupees. Why sales at 80? A sales should be at the rate of 120. No, in this particular situation, because these are related parties, they decide that, listen, let's not transact at 120 rupees, let's transact at 80 rupees. Why 80 rupees? Well, this is the price which is coming from the mechanisms of demand and supply. Not demand and supply. This is coming from the relationship that exists between the related parties. They decide that let's just transact at a price which is driven by our whims and fancies, which is driven by the relationship that exists between us. This is basically a manipulated price, and they decide to transact at 80 rupees. What is the benefit? The benefit is that now profit comes down to 20 rupees, and accordingly tax at the rate of 30% on 20 becomes 6 rupees. So in this particular situation, tax is at the rate of 6 rupees. Now, how did they avoid tax? Tax should have been 18 rupees, but now in related party situation, tax is 6 rupees. So how were they able to avoid that particular tax? Well, that is because they did not transact at 120 rupees. They transacted at 80 rupees. And because of that, they were able to bring their taxes also, down. This is really the problem that was supposed to be addressed by transfer pricing. We'll take this through another case study, right here. Now, in this particular case study, there is company F, and company F is in India. It's the tax rate in India, let's presume, is at the rate of 30%. Company F is actually selling a particular commodity. They are manufacturing the commodity, and then they are selling the commodity to company I. And then company I sells the commodity to a third party customer. Company I is in Singapore, and the tax rate in Singapore is at the rate of 17%. So what happens in this kind of situation? Well, we have company F. Company F is the manufacturer in India. They decide to sell the commodity to Company I, which is in Singapore, and then the Singapore company decides to sell the commodity through to third-party customer, which could be anywhere around the world. Now, company F is, the manufacturer. The cost of manufacturing this commodity is $1,200. They decide to sell the commodity to company I at $1,400. So what is the profit in India? The profit in India is sales minus cost, which is $200, dollars. Now, this is where I've mentioned, if you look at the black font here, I have mentioned that the profit is $200. The tax is at the rate of 30% in India. So that basically becomes, 60 rupees or $60 rather. Now, what happens is that company F sells the commodity to company I. So the purchase of goods for company I becomes $1,400. The sales for them is the purchase cost for them. And company I decides to put in an extra cost to this particular commodity of $100. And finally, company I decides to sell this particular commodity to a third party customer for $1,600. So if you look at it from the perspective of company I in Singapore, the selling price is 1600, purchase is 1400, and cost is 100. So the profit that they've made in Singapore is $100. So if you look at the right side of your screen, I've mentioned it here. The profit is $100. The tax in Singapore is 17%. So the tax becomes 17. And finally, they sell it to the third party customer. Now, if you look at this entire situation from the perspective of company F and company I put together, the kind of tax that they've paid is $77. How 77? Well, $60 of tax that they've paid in India and $17 of tax that they've paid in Singapore. So it becomes 77, dollars. Now, the thing is, this is an independent party situation. Now, let's look at this particular situation from a related party perspective. Now we concentrate on the red font, right here. When we look at the red font, let's look at company F and company I being related to each other. As in, maybe one is the parent company and company I is the subsidiary company. Now, company F decides that I'm not going to sell the goods to company I at the original $1,400. I will sell the goods to company I at $1,300. What will be the benefit? Well, the benefit could be tax avoidance, and we'll see how. Where is $1,300 the figure coming in from? Well, it's because of the relationship that exists between F and I. F and I companies are related to each other, so they decide that we're going to be dealing at a price which is because of our whims and fancies. We'll deal at a price which is which is helping us to manipulate price. So this is the reason they decide on $1,300. Now the profit in India becomes $1,300 less $1,200, which is $100. So if you see here, it's $100 of profit. Tax at the rate of 30% makes it 30. Now the product passes on to company I. Again, the purchase price is 1,300, sale is 1,600, and the cost remains the same at $100. So the profit in Singapore is $200. Tax at the rate of 17% makes it 34. And finally, if you look at it again from the group's perspective, the total tax that they're actually paying is $30 of tax in India and $34 of tax in Singapore, which makes it 64. Now, if you see, initially they were paying, when they were not related, they were paying a tax of $77. But now, because they got related and they manipulated the transfer price, which is this $1,300, the kind of tax that they paid was $64. So they were able to bring their tax down by indulging into something called as mispricing, unjustified pricing. And this is precisely the issue of tax avoidance. Now, what is done to address this particular issue? Well, this is where we have the concept of transfer pricing. Transfer pricing is an anti-tax avoidance law. It's just, a law which is there to make sure that related parties do not indulge in tax avoidance. So what transfer pricing will do is transfer pricing will come in this particular situation, which is situation 2, and transfer pricing will tell the related parties that, listen, you're not supposed to transact at 80 rupees. You're supposed to transact at something called as an open market price. So this is what transfer pricing is all about. And all through the concept, now we will be ascertaining what exactly are related parties, what exactly are international transactions, and what is this arm's length price. And that is what we will be, talking about. Now, this is what is meant generically by arm's length price. Arm's length price is basically a price between independent situations. So, what is the price at which independent parties are transacting at? That is basically called as the arm's length price. But one thing that you have to make sure, and one thing that you have to keep in mind, is that they are looking at comparable situation. As in, if you want that 120, which is the price at which independent parties are transacting at, this should be the arm's length price, then you'll have to make sure that this situation, which is situation 1, and situation 2, it's actually a comparable situation, right here. When I say comparable situation, well, there are factors that you have to keep in mind, as in the type of the product that they're talking about is the same, the economic conditions are the same. If this is India USA kind of situation, this should also be India USA kind of situation. If this company is a manufacturer, this related company should also be, a manufacturer. So you want to compare these two situations, and these two situations should be identical if you want to adopt 120 rupees as the arm's length price. Now, as I mentioned before, where is the arm's length price coming in from? Well, arm's length price is coming in from this concept which is called as arm's length principle. Arm's length principle is the international consensus on transfer pricing. As in, it's just, like a principle out there which is just making sure that if you feel that they are associated enterprises or they are related parties, then you have to make sure that they transact at something called as the arm's length price. Now, as I mentioned before, I will be just taking you through these particular concepts. As I mentioned, these particular concepts are very, very generic. They are, very, very simple out there. And then we will be talking about three concepts which are very important, even from an examination perspective, which is associated enterprises. Then I will be talking about international transactions, this one, and then I will be talking about transfer pricing methods. Now, when we complete a particular topic, I will be taking you through some questions also. We will be, talking about examples first, and then I will be talking about, some questions from past papers, or, some questions, for practice also. Okay, so coming back, this is how the structure of transfer pricing provisions look like in India. Now, this is the Finance Act 2001, which introduced transfer pricing provisions. This is Chapter 10 of the Income Tax Act, and it includes Section 92 to 92F. Now, right now, we're talking about sections 92 to 92F, but obviously, the Income Tax Act of 2025, has different sections. I'm not addressing them right now because, I don't want to confuse you from an examination perspective. This one is, going to be relevant for January 2026. Aparna, am I correct on this one? Uh, Aparna ma'am, am I correct on this one? Okay, so from January 2026, sorry, perspective, it's going to be Income Tax Act of 1961. So we will be concentrating on section 92 to 92F with respect to these particular sections. And I will be addressing all these, sections today. Now, these are the rules that are accompanying, the Income Tax Act of 1961. These are the relevant rules from Income Tax Act of 1962, which pertains to transfer pricing. Now, when you talk about transfer pricing in India, we have Section 92, which says that any income which is arising from an international transaction, it should be computed having regard to the arm's length price. Meaning to say that even from an Indian perspective, we have the arm's length price, as the benchmark. Now, the topic that we start with, the first topic that we start with for today is what are associated enterprises? This is the first one, and this is part of section 92A. Quickly, I will, just take you through section 92A and we will revise through, this particular section. And this is the first technical concept, which basically means that, when you have transfer pricing applicable, when you feel that transfer pricing will be applicable, well, then it is applicable on associated enterprises. So the point is, what are associated enterprises? Well, this is section 92A, and subsection 1 talks about a generic definition of, associated enterprises. It basically says that two enterprises will be related to each other when one enterprise participates in the management, control, or capital of the other enterprise. Now, what is management, control, and capital? Unfortunately, these are not defined under the Income Tax Act, but it's only through case laws that you can identify what is management, control, and capital. But this is what I'm really trying to say. This is a generic definition in subsection 1, which says that if there is company A and company A participates in the management, control, and capital of company B, well, then company A and company B will be associated to each other. Now, even if company A, through an intermediary, it participates in the management, control, and capital of company B, well, then also company A and company B will be associated to each other. And then, section 92A talks about a third category, which says that even if there is a same person and this person participates in the management, control, and capital of company 1, and this person participates in the management, control, and capital of company 2, well, then company 1 and company 2 will also be associated to each other. So this is what section 92A talks about. Now, in section 92A, subsection 2 is a little bit, more technical, and it says when are entities deemed to be associated entities. So what they've done is they've come up with 13 instances out there. And these 13 instances, if you satisfy, then two enterprises will be associated to each other. So what are these 13 instances? That is what we will be, talking about. So the first instance in section 92A subsection 2 talks about these instances. This is clause A, and it says that if one enterprise holds or gets involved or holds directly or indirectly share capital 26% or more in the other enterprise. It says voting power in the other enterprise, well, then they will be associated to each other. Now, what exactly is this voting power? Well, a lot of things that you have to keep in mind from an examination perspective in this particular clause is that they say direct or indirect holding. So direct holding and indirect holding both count. The second thing that they talk about is voting power. How does voting power come into existence? Through holding equity share capital. Preference share capital does not count here. So if one enterprise holds more than 26% share capital in the other enterprise, then they will be associated to each other. Then there is clause B, which says same person holds 26% or more voting power in the other enterprise. This is a situation like this. Mr. A holds 40% voting power in X Limited and Mr. A holds 40% voting power in Y Limited. This is the reason because they have a common person. This is the reason X Limited and Y Limited will be associated to each other. Then they talk about the third one, which is provision of loan not less than 51% of book value of total assets. Now, this is where they say that if one enterprise holds 51% or more of the book value of total assets, if they provide a loan, then they will be associated to each other. Meaning to say that if there is company A and company A gives a loan to company B, and this loan is 51% or it is more than 51% of the book value of total assets, then they will be associated to each other. Now, the thing is, what you have to keep in mind from an examination perspective is the threshold right here. They say 51% or more than 51%. Only then association will actually happen. And then they say book value of total assets. So it's not market value that they're looking at. They're looking at book value of, total assets. Clause D talks about guarantees. So if one entity gives a guarantee on behalf of the other enterprise and the guarantee is 10% or more, then also the entities will be associated to each other. Apart from these conditions, there are also some other conditions which are these particular conditions, which is the management conditions. So if there is a board of director or there is a governing board and one entity appoints more than half of the board of directors or governing board in the other enterprise, or they actually appoint executive director, and this executive director is either one or more than one executive director, then also they will be associated to each other. Now, what you have to keep in mind is that we are looking at the board of directors, or we are looking at governing boards right here. So remuneration committees and audit committees, they are not included in the governing boards out here. Also, independent directors do not count. We're looking at executive directors or executive members. So independent directors, they are non-executive directors. They help in improving the corporate credibility and the governance standards of the company. So they are not included, right here. Then the last few conditions that will help in association are basically sort of called as control conditions. It's not as if the law has actually called them control conditions. It's just for our understanding that we have actually called them control conditions. Now, the first one is complete dependence on intangibles. So if one enterprise is completely dependent on the other enterprise for manufacturing, and how are they completely dependent? Well, using the intangibles. They are manufacturing by using the intangibles of the other enterprise, and there is 100% dependence. Then only they will be called as associated enterprises, because this is complete dependence. So complete basically means 100% dependence. Then there is condition H, which is supply of raw materials 90% or more, and the prices and other conditions relating to the supply are influenced by such other enterprise. Now, this is where if one enterprise is actually supplying raw materials to the other enterprise and it's actually 90% or more, then only they will be associated. This is the third, which is goods manufactured or processed by one enterprise are sold to the other enterprise. And then the conditions are influenced by the other enterprise. Or if there is common control by individual and or the relative. Or if there is common control by HUF and or its member. Meaning to say that if there is an individual, they actually control a company, and the individual's relative, which is relative for the purposes of Income Tax Act, they control another company out there, then the two companies will be related to each other. Then let's say that this is an HUF. HUF is controlling A Limited, and the member of the HUF or the relative of the member of the HUF is controlling B Limited. Well, then A Limited and B Limited will be associated to each other. Why? Because the HUF and the member of the HUF together are holding these two or controlling these two companies. So this is basically K. Then in case of firm, AOP, BOI holding 10% or more interest, and then M specifies relationship of mutual interest, which may be prescribed, but nothing has been prescribed by CBDT as yet. So this is, what association really looks like. Now, this is a question, from past papers, which is which has basically three parts. I'll allow you 3 minutes to actually go through these three, questions, and we will come back and discuss these three questions. So just take 3 minutes and read through these three parts right here, and then we will discuss it. Okay. So if you look at, these three examples, if you look at the first one, there is association, yes, and that is because the company has advanced a loan of 51% or more to the other enterprise. Now, there are a lot of things that you have to keep in mind in this particular situation. The first thing is the market value of assets will not count because we are only looking at the book value of the assets in this particular situation. So the market value will not count at all. Now, they repaid 10 crores before 31st March 2024, and this particular situation will also not count. Why will this not count? Well, because association is taken at any time during the previous year. So it's actually at any time. So whether it was this amount of 53 crores, and if something was actually repaid 10 crores, it does not really matter because through the year it was 53 crores. Where is it written in law? Actually, it's mentioned right here. You have to test association at any time during the previous year. This is the reason whether it was 53 crores or 10 crores were actually repaid will not be taken into consideration. And then this is taken into consideration. So there is association, yes. In the second one, there is no association because what they actually appointed was only two directors, and the law says more than 50%. This is only 50%, so there is no association. And the third one is very tricky, but then in this particular situation, also there is no association, although the supply of raw materials was 90% or more. And there was no association because in this particular situation, it was actually market conditions. It was dependent on market conditions, and they were not dependent on, they were not influenced by, the other enterprise. So even in this particular situation, there will be no association, right here. So this is what you have to keep in mind. There are small things that you have to keep in mind, but this is, the kind of questions that is very important to test. Now we move to the next concept, which is international, which is the meaning of international transaction. And these are one of the, this is section 92B, and these are some of the, meanings of international transactions that I have talked about. International transaction could be anything, tangible property transactions. So, purchase and sale of, tangible product, intangible product, building, vehicle, machines, etc. Intangible product, sale, purchase, or use of intangible property, capital financing. So whether it is loans and guarantees, all these are international transactions. It could be provision of services, so market research services, development services, accounting services, etc. And then business restructuring transaction. Now, another concept which is very important, to be seen is the concept of deemed international, transaction. Now, this is the concept of deemed international transaction. This is coming from section 92B, subsection 2 of, the Income Tax Act. And what I've done is I have mentioned the section, right here. So this is what the section really looks like, but it's a little tricky. So I will explain it using this particular diagram right there. Now, this particular diagram basically says that if there is a foreign associated enterprise and then there is an Indian enterprise, okay? Now, if these two enterprises, they transact between themselves, obviously transfer pricing provisions will be applicable. So if this Indian enterprise transacts with the foreign associated enterprise, transfer pricing provisions will be applicable. Why? Because this is an Indian enterprise and they have a associated enterprise. It is an overseas associated enterprise. So associated enterprise is there. International transaction is there. So what they actually decide now to circumvent transfer pricing provisions, they decide that let's have an unrelated enterprise or an unrelated person, built in right here. What will be the benefit? Well, now the Indian enterprise will transact with the unrelated person, and the terms and conditions, or uh, the terms and conditions on which they actually transact, the Indian enterprise and the unrelated person, they will be determined by the foreign associated enterprise. And this way, they will circumvent transfer pricing provisions. So, what the CBDT did was that they came up with the concept of deemed international transaction, and they said that that transaction between the Indian enterprise and the unrelated person, will be called as a deemed international transaction. Now we know that this is not an international transaction, but still, for the purposes of Section 92B, subsection 2, the CBDT said that this will be called as a deemed international transaction, meaning to say that transfer pricing provisions will be applicable on this transaction as well. So this is the concept. Now, the Finance Act of 2014, they expanded the scope of deemed international transaction, and they said that even if this non-associated entity, this unrelated person, even if this is in India, then also we'll call this particular transaction as a deemed international transaction, meaning to say that this ICO is now transacting with this non-associated enterprise, and both of these enterprises are in India, but still we will call it as a deemed international transaction. I know that this is a transaction between two Indian companies, but still this will be called as a deemed international transaction, and transfer pricing provisions will be applicable. Now, after the concept of AEs and international transaction, the third important concept from a transfer pricing perspective and also important from an examination perspective is the overview of transfer pricing methods. Now, when it comes to transfer pricing methods, there are 5 methods that are provided in the OECD transfer pricing guidelines. There are 5 methods in the UN transfer pricing guidelines. But from an Indian perspective, there are 6 methods that we will be talking about. Now, when it comes to the methods, um, there are 3 traditional transaction methods, which are comparable uncontrolled price method, the resale price method, and the cost plus method. These are the traditional methods, out there. And then there are transactional profit methods, which is TNMM, which is transactional net margin method, and the profit split method. Now, these are the 5 methods provided in India, provided in the OECD. But in India, we also have a 6th method out there, which is called as the other method. Now, just to give you, a brief perspective out there, is that there are these direct methods. These 3 are basically called as direct methods. They are direct method because they are quite simple. Adjustment is not required. The comparison is far more easier. And then there are transactional profit methods out there, as in those methods are unique, valuable contributions are made. They are more technical in nature. And they are more focused on the profitability out there. There was a time that there was a hierarchy of method provided, but now there is no hierarchy of method, and we look at something called as the most appropriate, method. As in, what is the method which is best suited to the facts and circumstances of each international transaction or the domestic transaction? What is the method which provides the most reliable measure? That is the method that we will be talking about. So let's start with the first method, which is comparable uncontrolled price method. The comparable uncontrolled price method is a very simple method. It just says that, what is the price which is charged in an independent situation? Look at that particular price. What is the price at which independent parties are transacting at? Look at that particular, price, and then you compare it with your transaction and then replicate it. So basically just copy paste that particular method. And this is the most direct method. But then for this particular method to be applicable, you need to have all the information on the independent party out there. So what is the price at which independent parties are transacting, and is it comparable? As in, the product should be the same, the type of market should be the same, the product line should be the same, the economic circumstances should be the same, the business strategies between these two enterprises should be the same. Then you can adopt that uncontrolled price as the arm's length price. This is the CUP method. Now, when it comes to CUP method, there are these 2 kinds, which is external CUP and internal CUP. What is external CUP? Well, external CUP is something that I just mentioned about. Let's take this example. We have 2 associated enterprises. AE1, which is basically selling unbranded Colombian coffee beans, to AE2. This is basically a controlled transaction, as in a transaction between associated enterprises. Now, we need to find out whether this is at arm's length or not. So what we do is we find out for a comparable transaction. We find out that there are two independent parties in the market. There is non-AE1 and then there is non-AE2. As in these two enterprises are not related to each other at all. And they are also selling unbranded Colombian coffee beans. So we see what is the price at which these are transacting at, and we adopt this as the ALP for this kind of transaction. So we use something called as external CUP. External because we find out external parties and we adopt their price as the arm's length price. Then there is also something called as internal CUP. Internal CUP basically means that there is ICO 1, and this ICO 1 is selling unbranded Colombian coffee beans to FCO, and they are related to each other. So we need to actually certain whether this transaction is at ALP or not. How do we do that? Well, we look at a non-AE and we actually find out that this ICO is also selling unbranded Colombian coffee beans to this non-associated enterprise out here. So what we do is we use this particular price and we adopt this price as the ALP for this controlled transaction. So this is called as internal CUP. Now the next method that we have is something called as the resale price method. The resale price method is basically applicable in case of traders and distributors. So in an examination kind of format, if everything goes, fine, if the facts and circumstances remain fine, if the question says that this is applicable for traders and distributors, a lot of chance it could be a resale price method also, because this particular method is applicable for traders and distributors. This is where, let's say that there is a parent company and the parent company sells a particular product to the subsidiary company, and the subsidiary company, without any major value addition, it does not do any value addition to the commodity, but it actually sells that particular commodity to the end customer right here. That is where resale price method will be applicable. So then you need to justify that this particular price, which is the transfer price, which is the controlled transaction between the parent company and the subsidiary company, this price is at arm's length. How will you justify that? Well, if you're able to justify that the profit made by the subsidiary company is also the profit which is made by other parties in the subsidiary company, you could be able to, justify that. So that is the resale price method. Now, the next is the cost plus method, and the cost plus method is applicable for manufacturers. It is applicable for semi-finished goods between related parties. It is applicable for contract manufacturing arrangements out there. So this is where you could have a subsidiary company, and the subsidiary company is, let's say, incurring direct and indirect cost of production, sorry, and they're actually incurring a cost of production of 100 rupees, and they're selling something to the parent company for 125 rupees. Now you need to justify that this 125 rupees is at arm's length because this is the controlled transaction. How will you justify that? Well, if you justify that the 25% margin which is made by the subsidiary company at gross level is at arm's length. How will you do that? Well, you need to find out other independent parties who are also doing the same, who are also incurring similar type of gross profit. That is where you will be able to justify that. The next is transactional net margin method. Now, the transactional net margin method actually examines the net profit in a particular transaction. So if you have a transaction, you have to calculate the net profitability of that particular transaction and compare it with the net profitability which is earned by an independent party in the enterprise, in the independent enterprise out there. If you're able to compare the net profit and that is at arm's length, then you have applied the net transactional net margin method. So it basically examines the net profit which is relative to a particular base. When I say that it is relative to a particular base, this terminology is called as profit level indicator. It basically is the net profit divided by an appropriate base. It could be cost sales, And then you have to compare the same thing, net profit by sales, with the independent party. And that's how you're able to establish the transactional net margin method. Now, under the transactional net margin method, there is a concept which is called as, the tested party. The tested party is basically the party for which you are calculating the profitability. Um, in case of, TNMM. Now, there is no definition of tested party out there, but it's only the least complex entity which is considered as the tested party. Now, how will you see which is the least complex entity? Well, the least complex entity is the one which does not have, intangibles, which does not require adjustments, for which data is readily available, information, financials, these are readily available. That is, the tested party. After that, the fifth method out there is the profit split method. The profit split method is where the transactions are so interrelated that you cannot segregate them on an individual basis. So you have to calculate, or you have to benchmark the transaction on, on that particular level in interrelation method. That is basically the profit split method. This method is most applicable for, intangible kind of situations. Whenever you see intangibles being applied, that is where you can use something called as the profit split method. And finally, the method which is used in India is called as the other method. Now, the other method is basically based on quotations. When I say third party, quotations, it is basically the price that would have been charged if that similar or same uncontrolled transaction was happening under similar circumstances. For this, we use third party data, we use valuation reports, third party quotations, etc. And that is basically, the other method. So what I've done is I have just mentioned this slide here, which basically says which method is, used when. CUP is used for, loans and service, any transaction. As long as you have data available for that kind of transaction, this method is going to be used. Then RPM for distributors, CPM for contract manufacturing situations, TNMM for provision of services, manufacturing. As long as you have net profitability available, you can use, the TNMM method. And PSM when there is existence of unique intangibles, or when the transactions are very interrelated, to each other. And finally, there is also other method which is using third party quotations, but that is a method which is specific to India. Just remember that. Now, I have taken a question from January 2021, which talks about the method to be used in these three, circumstances. So I think again, take about, 3 minutes, read these three circumstances and try to ascertain what method will be used in these three situations, and then we will, discuss it. But the question asks you that for these three situations, what will be the best method that will be available right there? Okay, so if you look at the first situation, this is where you could use TNMM method for the purposes of benchmarking. Why? Because as long as you're able to substantiate it, I think it's well and good. This is where you can calculate the net profitability and compare, the two transactions. Then in the second one, because it talks about gross profit markup and it talks about manufacturing situations, you could use a CPM, which is cost plus method. And in the third one, because these are identical costs, call center services to both related and unrelated parties, and you have information available on unrelated parties, you could easily use a COP method, which is the comparable uncontrolled price method. Now, when it comes to the data which is to be used for analyzing comparability, generally we do not use current year data, and that is because current year data may be distorted by differences in market or economic conditions, etc. And this is the reason we actually prefer using a multiple year, data, because the multiple year data will ensure that the outcome is not unduly influenced by abnormal factors or differences, etc. So this is the reason where you have RPM, TNMM, CPM being used. You could use multiple year data for the purposes of comparability or benchmarking. Now, another important concept is if you have multiple independent parties available, if you have multiple comparables available, there was a time that we used to use arithmetic mean, but now we use something called as an arm's length range. So the kind of arm's length range, in that we actually calculate a percentile. So 35th to 65th percentile of the data set is what we use in India when we have six or more comparables. But then if you have comparables till five, then you still use the arithmetic mean out there. So for two, three, four, five comparables, you use arithmetic mean. After that, you switch to the concept of arm's length range. Now the arm's length range that we use in India, as I mentioned, is 35th to 65th percentile of the data set. But then the one that you use outside India, as in what OECD has actually mentioned, is 25th to 75th percentile out there. Now, the next topic that we have is basically transfer pricing documentation. This is the importance of transfer pricing documentation. But transfer pricing documentation, in that we have two things out there. One is something called as Form 3CEB that we have in India. And then the other thing, what we have is basically called as the TP study. This is how the accountant's report or Form 3CEB looks like. This is like a mandatory report that you have to fill and submit or upload to the income tax department's portal. There is mandatory e-filing by the 31st of October. And this will basically provide an opinion whether the value of international transaction or specified domestic transaction is at arm's length. And it will also certify the value of international transaction as per books of accounts, etc., and whether it is true and fair. The next thing, these are the details that are furnished in Form 3CEB, which is, you have to put in all the details relating to the associated enterprises, the category of the transactions, the description of the transaction, the volume of the transaction, etc. And this is what TP study really looks like. This is coming from section 92D, rule 10D of the income tax rules. And this is a very elaborate document, which basically will say all the information relating to the enterprise, which is, the ownership of the enterprise, the group structure, the details of the AEs, etc. Then it will talk about all transaction specific details also. So, what is the value of international transactions, what is the FAR analysis, what is the economic analysis, and then it will also talk about all the computation. So what is the most appropriate, method? How do you really compute the arm's length price? The assumption, the policies, the adjustments, etc. So every detail relating to calculating the arithmetic mean or the arm's length range, everything goes into the computation related part. So this is a very, very elaborate document. There is a threshold limit for this document. So no threshold limit for Form 3CEB. But this document has a threshold limit. If the aggregate value or the book value of international transactions, it should not exceed 1 crore. Then it's not mandatory. But then if it exceeds, then this particular document is actually, mandatory to be filled. Now, apart from this, what we have is also OECD BEPS Action Plan 13, and they have given us a three-tier documentation structure. They said that you have to maintain something called as a local file, master file, and CBCR. A local file is basically like the entity specific document, the TP study that I just mentioned, that's something like, the local file where you have all the documents, all the material related party information, all the entity specific, information, everything, all the details go into the local file. Then there is something called as a master file, which is like a high level, overview. So it's going to talk about what is the supply chain, what is the value chain, what are the key service arrangements, etc. And then there is something called as CBCR, which is country by country reporting. It's going to be filed in the parent's jurisdiction. And this will say that, for each jurisdiction where the entity is operating, what is the revenue, what is the profit before income tax, what is the income tax paid, what is the, the employees, what are the retained earnings, etc. It's going to give all that information for all the jurisdiction where the entity is actually operating. Now, this is one of the questions which was, there in one of the papers, which said that under BEPS Action Plan 13, BEPS report recommends that countries adopt a standardized approach to transfer pricing documentation. So there is a master file, local file, and country by country report that we just read about. What are the advantages? Now, this was a 3-mark question where they mentioned these 3 advantages. This is the answer. The answer basically says that, the taxpayers will be required to articulate consistent transfer pricing position. So, whatever is the transfer pricing position that you have taken in one jurisdiction, it will all be accumulated in a country by country report. So it will be consistent transfer pricing position that will be reflected in the master file when compared with the local file and the CBCR. Then the tax administration will get useful information if they want to do a transfer pricing risk, and then they will be able to make determination that where their resources need to be deployed, and they could target their audit inquiries accordingly. Now, when it comes to country by country reporting, it was actually Section 286 where India incorporated the provisions relating to CBCR. And this is where there is a threshold out there. So CBCR requirements come into existence in India, where the threshold is 6,400 crores, or more. Then there is the requirement for master file also in India, as I mentioned, and this is coming from Rule 10DA, 1. This is where, the requirement comes into existence where the consolidated group, as per the books of accounts, exceeds 50 crore, or the intangible transactions are more than 10 crore. Then only you will have to maintain, master file. Just remember that there is and here, and then there is or out here. So this is something that you need to keep in mind. The next topic that we have is basically safe harbor rules, which is coming from section 92 CB. Now, what are these safe harbor rules? Well, the safe harbor rules are defined in Income Tax Act, and they're basically circumstances. So, the Income Tax Act has defined certain circumstances that if these kind of transactions are actually undertaken, then this will be, this will be basically the transfer price that will be accepted. In simple words, they have actually defined some circumstances, and they with those particular circumstances, they have identified that what is the transfer price that should be declared by the transfer that should be declared by the taxpayer that will be accepted out here. So, as an example, this is some examples that they have actually defined. So they basically say that if you are providing software development services, well, then the margin, if it is 20% or 22%, looking at the aggregate value of the transaction, that will be accepted as the transfer price. These are basically called as safe harbor rules. Then they have also provided Same thing for ITES services, information technology enabled services, that, the operating profit margin, if the aggregate value of the transactions are not exceeding 500 crores, then it should be 20%. Otherwise, it should not be less than 22% if the value of transactions are exceeding 500 crores. So these are the kind of, circumstances that have been defined by the income tax authorities. And these are, the um, uh, profit margin that they have also defined, that will be accepted as the transfer price if declared by the assessee. So these are, some of the transactions that I've mentioned here, which have been defined: software development services, ITES, KPOs, contract research and development services, IGS, etc. Low value added intra-group services, etc. Now, the next topic that I have picked up is basically APAs. This is coming from Section 92CC and Section 92CD of, the Income Tax Act. Now, what is an APA? APA is basically like an agreement or an arrangement between two enterprises, between the tax authorities and the taxpayer, and they will actually sit and negotiate, and they will determine in advance of the international transaction an appropriate set of criteria. They will determine that, going forward also they will have the same kind of transaction applicable. So what will be the method, what will be the comparables for this particular transaction? That determination is basically called as APA. This, so, if you actually look at the concept of APA, it's more like an agreement between the taxpayer and the taxing authority, and they will decide an appropriate transfer pricing methodology. Um, and this is the way there will be a lot of certainty, and there will be a lot of unanimity in, the approach that will be actually adopted. This is basically the concept which is called as APA, or advance pricing agreements. Now, the APA that will be entered into, it will be binding on, the person, who's actually entering into the APA, actually the taxpayer, and it will be applicable on the principal commissioner, the commissioner of the income tax. It is if there is obviously change in fact, because APA is based on a particular law and it's based on a particular fact out there, and if there is change in any fact, etc., then APA will not be binding out there. Now, the APA is based on a lot of negotiation, because, the taxpayers and the tax authorities will sit together and negotiate, and it will require the consent of, these parties actually who are signing, and it will be there will be a lot of set of assumptions out there for APA. This is where I've just mentioned the APA filing fee. So for transactions up to 100 crore, the filing fee is 10 lakh. Other than that, there is, uh, 15 lakh. And then more than 200 crore, there is 20 lakh. Now, what is this concept of rollback provision in APA? Well, if you look at the validity of APA, APA is generally valid for a period of 5 years. So if today I decide to sign in an APA, it's going to be applicable for the next consecutive, 5 years. And then obviously it can be renewed for another set of, 5 years also. Then there is a rollback provision. APA can be applicable, before 5 years also. So it can actually, you can roll back and take APA for 4 prior years also. So this is the reason APA will be applicable for 9 years, out there. So 5 years going forward, and 4 years going backwards. So in India, you can actually get, certainty. um so in India, you actually get certainty from APA for a period of 9 years, 5 years going forward, and then 4 years rolling back. Obviously, you can, get APA for, further 5 years also. So that's, actually a good thing. So 9 years at one time is the certainty, that you actually get. Now, this is the reason they've mentioned here, which is the rollback, which is, if you take rollback provisions, going back 4 years, then also it's going to be 5 lakh APA filing fee. Sorry. Now, this is, a slide where I've, just mentioned about a few things which is coming from, the law itself, which is revision of APA. Can the APA be revised? Well, yes, if there is change in critical assumptions, or if there is change in, law, etc., then it can be revised. Can it be cancelled? Well, yes, there is a lot of compliance with APA, which is the annual compliance report, etc. So it can, if, if there is failure to file the annual compliance report, or if there are material errors, etc., then it can be cancelled also. Can the APA be renewed? Well, yes, the APA has to be, it can be removed, not has to be, but it can be removed, and APA can be withdrawn also. You can withdraw APA, also. These are again, some of the questions that I have mentioned, from these are two questions. So just take a minute and, just read through these two questions out there. This is the first question, and then this is the second question. I'll give you 3 minutes again to just read through these two questions, and then we'll discuss it. Okay, so if you actually look at, the first question right here, this is where it says that company X and company Y have entered into APA, and they actually have they are eligible for rollback provisions also, and they are merging to form a new company XY. Now, will this provision be available to XY? Well, no, this will not be available to XY, because there is change in critical assumptions, there is change in facts, etc. And because the APA was available to X and Y separately, it's not going to be available to X and Y, which is basically the merged company. The second one is APA, once entered by the taxpayer with the income tax authorities, cannot be modified or revised. Well, it's not correct, because as I mentioned here, it can be modified. and it can be revised also if there is change in assumptions, etc. Now, the next topic that we have is basically secondary adjustment. Now, secondary adjustment is, there is something called as primary adjustment, and then there is something called as secondary adjustment, in transfer pricing. If you look at the concept of, primary adjustment, this is where, as I mentioned before, that when it came to related parties, the tax that was being paid was 6 rupees. But out here, between independent parties, the tax that was applicable was 18 rupees. So, what will happen in this kind of situation between related parties? Tax authorities will see that, there was tax avoidance situation. So, when they actually make transfer pricing applicable, they will add back 40 rupees of profit here. The profit right here is 20 rupees. The profit should have been 60 rupees. So when transfer pricing provisions become applicable to this kind of situation, the tax authorities will add back 40 here, and then they will make the profit 60, and then they will tax it accordingly. So there is a transfer pricing adjustment out here, which is of 40 rupees in related party situation. This transfer pricing adjustment is also called as primary adjustment. So, primary adjustment is basically the adjustment which is in accordance with the arm's length principle. That is basically called as the primary adjustment. Now, there is also something called as secondary adjustment. Secondary adjustment basically means that, you've, by virtue of primary adjustment, you've made an adjustment in your books of accounts, which is, 40 rupees right here. Now, you need to make sure that these 40 rupees actually are remitted to the Indian company also. As in, there should be, now primary adjustment was adjustment in the books of accounts for tax purposes. Now, these 40 rupees, they should be remitted to the cash profits or the book profits of, the related party also, the parent company also. They should be remitted to India. That is basically called as secondary adjustment. So this is where I've just mentioned everything about secondary adjustment. That secondary adjustment is applicable from the Finance Act of 2017. And this is basically to make sure that the cash profits are in line with tax profits after primary adjustment. And this particular concept of secondary adjustment is basically applicable when there is a primary adjustment. Now, this primary adjustment can be made suo motu by the assessee in its return of income, or they're made by the transfer pricing officer, as in the assessing officer, or sorry, it's by virtue of APA, or this is because of safe harbor rules, or because this is because of, MAP. So as long as there is primary adjustment, it is followed by something called as secondary adjustment. And because this concept came in after the year AY 2016-17, it's going to be applicable after that. And this is, where the primary adjustment exceeds 1 crore rupees. So this is where I have actually summarized, the whole concept of primary and secondary adjustment. Now, this basically happens when the Indian company is transacting with the non-resident AE, and the transaction is not at arm's length price. So there could be, like total income increases, or there could be a reduction in loss. Now, when this happens, there is a primary adjustment. Now, only when the primary adjustment is more than 1 crore rupees, secondary adjustment comes to India. Secondary adjustment basically means that you need to now remit that adjustment back to India. What happens if it is not remitted? Well, this is where it should be remitted within a period of 90 days. I will just show the slide where it talks about all the, thresholds and all the time limits, etc. But generally it is 90 days. That this should be remitted with, in 90 days. What if it is not remitted? Well, this is where the Indian law basically says that if the amount is not remitted, then we'll just presume that the Indian company has given a loan to the outside entity, to the non-resident AE. What if it's a loan? Well, if it's a loan, like a deemed loan that the Indian entity has actually given, then the Indian entity should get an interest onto that particular amount. So one, you have to remember that If it is not remitted, then this is a deemed loan, and there will be interest on deemed loan, and this will be added as income to the Indian taxpayer, Indian company out there, and they'll have to pay tax on this particular amount. So this is what is mentioned here, that non-repatriation that will be considered as an advance um, if it is not remitted. And this is when I say that this is considered as an advance, it is also considered as a deemed loan. Now, this is where it actually prescribes the time limit out there. It's actually on or before 90 days from what is mentioned out here. And this is the interest. If the excess money is not repatriated within the time limit, then there is obviously interest that will be, chargeable. And this is where the international transaction is in Indian rupee, then it's SBI, and where it is denominated in Indian foreign currency. Well, the law says, LIBOR, but CBDT has not yet issued like a blanket replacement formula, but then they have acknowledged that they're moving away from, LIBOR, etc. Now, this is where another thing that they have mentioned is that what if that this is not repatriated within the time limit? Well, then you have an option also, that what you can do is you have the option the assessee can pay a one-time tax, an additional income tax at the rate of 20.9664%. So they can pay tax at the rate of 18%, plus there will be surcharge at the rate of 12%, plus cess at the rate of 4%. So total they can pay an additional income tax of 20.9664%, and then they will not be required to make secondary adjustment and then impute interest, compute interest from the date of payment of tax. We'll just presume this as final payment of tax, but then there will be no deduction that will be available for this amount of additional income tax under any provisions of the Income Tax Act. So what you have to remember, just as a summary for secondary adjustment, is that the amount should be repatriated to India. What if the amount is not repatriated to India? Well, this will be considered as a deemed, loan out there. And if this is a deemed loan that the Indian entity has given, then the Indian entity will receive interest on this particular amount that will be chargeable to tax in the hands of the Indian entity. But if this is not repatriated, well, then there is an option to pay an additional income tax at the rate of 20.9664% out there. And then there will be no requirement to make secondary adjustment. And then there will be no requirement to impute interest also. This will be considered as final payment of tax, but then no deduction will be allowed in respect of this particular amount. Now, again, this is one of the questions, that I have mentioned here, that what will be the consequences if there is suo motu enhancement to the transfer price of 14.40 crores on the determination of arm's length price while filing return of income. Well, this is where what will be the consequences. If there is a suo motu enhancement of transfer price, well, then this amount of 14.40 crores, this will be called as primary adjustment. If there is primary adjustment, there will be secondary adjustment because this amount is more than 1 crore rupees. So if this amount has to be repatriated to India within a matter of 90 days, if it is not, well, then this will be considered as 14.40 crores of deemed loan. And this loan will attract interest, which I have, mentioned here. And that will be added as income of the Indian company. But if this amount is not repatriated within this particular time, then there will be, you can pay an additional income tax of 18% plus surcharge and cess, which is 20.9664%, and that will be considered as the final payment of tax. So this is everything that you have to mention in this kind of, question right here. Now, the next topic that we have is something called as limitation of interest deduction, which is section 94B. Now, limitation of interest deduction basically means these are also called as thin capitalization rules. Now, these are, situations where it talks about the level of debt and equity in a particular company. The higher the level of debt in a company, the amount of interest that it pays, the lower will be taxable income, because the higher is the debt. And this is the reason most multinational companies, they make their financing arrangements in a way that they want to minimize, they want to get into intra-group financing. They want to have a high level of debt so that the kind of taxable income that they have will be the least. So they claim excessive interest deduction out there in high tax jurisdiction. Now, to make sure that this kind of situation does not happen, India introduced Section 94B. Now, what is Section 94B? Well, they have, this is in line with OECD BEPS Action Plan 4, and they basically provide that the interest expense that is claimed by an entity when they have obviously borrowed a loan from its associated enterprise, that will not exceed a particular threshold. And that will be the maximum amount that will be deductible when you are computing PGBP, profits or income. So this is the excess interest. They basically say that interest will not exceed um, the total interest paid or payable, which is in excess of 30% of EBITDA, or the interest paid or payable, whichever is less. But then again, this kind of provision will be applicable by way of interest only if it exceeds 1 crore rupees. So this is where I have, just summarized limitation of interest deduction rules. Um, is the borrower an Indian company or PE of a foreign company? If no, then Section 94B will not be applicable. But if yes, then it will be applicable. And then you have to see what kind of, entity it is, and then the lender, and then the interest should be more than 1 crore rupees. Then excess interest will not be allowed. And what is the meaning of excess interest? It is the interest paid or payable in excess minus 30% of EBITDA, or the interest paid or payable, whichever is lower. Now, the last topic that we have, for today is basically the topic of advance rulings. If you have questions, this is where we finished with transfer pricing. But then if you have any questions with respect to transfer pricing, just feel free again to put it on the chat box, or you could, just put it on the portal also. I will just look at the questions, later from there. But the next topic that we have is basically the topic relating to advance ruling. Now, what is the concept of advance ruling? Advance ruling is basically, like a written opinion, or it's basically an authoritative decision which is given by an authority, and it will talk about the tax consequences of a proposed transaction. So, if today I decide that I'm going to, undertake a transaction going forward, I can go in for advance ruling, and they will give me a written opinion that what will be the tax consequences if I undertake that particular transaction, what will be the tax consequences. So initially we used to have the authority for advance ruling, which was called AAR, but now what we have is something called as BAR, which is the board for advance ruling. It constitutes the board of advance ruling. It constitutes of the members of the income tax department, at least the rank of chief commissioner, and above. And um, even if there is, any vacancy, or there is defect in the constitution of board for advance ruling, any pronouncement that they actually make, any ruling that they give, or any proceeding, it will not be questioned, it will not be invalid, just because there was a vacancy in case of bar. Now, this is where I have just mentioned who all are the applicants. This talks about a non-resident, which can be an applicant, or a resident, for the tax liability with a non-resident. If you look at this kind of situation, a resident assessee, if you have a resident assessee, they cannot pursue both the remedies. They cannot go in for appeal or revision, before the income tax authority or the appellate authority, as well as advance ruling. They cannot, do both with respect to any issue. They have to choose, one. Then this particular table talks about um, resident of class or category of persons which are notified by the central government. Then it talks about public sector undertaking which have been notified by the central government. They can also go in for authority for advance ruling, even if there is matter which is pending before any income tax authority or appellate tribunal, etc. Now, this is where I have mentioned, the procedure. It provides that an applicant can actually withdraw an application within 30 days from the date of, the application. But this particular table will talk about just the fee that is actually required for going in for an advance, ruling. More importantly, this is the procedure. It basically says that the board will not allow an application for advance ruling if you have a matter which is already pending with the income tax authorities or the tribunal or the court. So if you have a matter which is already pending before the income tax authority or appellate tribunal, then you cannot go in for an advance ruling. They will not allow an application. But if there is any resident which is notified by the central government, they can seek advance ruling even if the question raised is pending before the income tax tribunal. This is where I've mentioned about this particular public sector undertaking also. Then, if a matter involves determination of the fair market value of any property, then also the board will not allow an application. And finally, if you feel that there is a transaction which is prima facie for the avoidance of income tax, it is designed for the avoidance of income tax, then also they will not allow an application. Even if the application is accepted, the board will have to pronounce the ruling within a period of 6 months from the receipt of that particular application. Finally, this particular slide mentions about advance ruling to be void. So it basically says that if you feel that there is an advance ruling, a representation which has been made by the applicant by fraud or misrepresentation of facts, etc., then the board will actually declare it to be void ab initio. And then as per the amended provisions of the act, an order of bar would not vote for advance ruling. It will not be binding on either of the aggrieved parties. So the taxpayer or the income tax authority, they have the liberty that they can file an appeal against the order of the board for advance ruling with the high court. So next level, they can go to the high court. It's not going to be binding as such. So this is where the appeal can go to the high court, by the applicant. Finally, what we have are, the questions. This is a question which is based on November 2022, which is based on authority for advance ruling. If you read through the first question, it says, Mr. Ricky, a resident individual, is aggrieved by an order passed by the board for advance ruling on 1st October 2021. Since the decision of the board is binding on the applicant, he has no other option but to accept the ruling of the board. Well, this particular statement, if you see, is absolutely incorrect. And why is it incorrect? Well, that is because the board for advance ruling, after 1st September 2021, they can actually, they have the option of going to the high court if they are aggrieved by the application. It's not going, if they are aggrieved by the board of advance ruling pronouncement, and that is because they are not binding. They're not binding on the taxpayer and they're not binding on the income tax authorities. So they have option to go to the high court, not accept the ruling of the board. The next one is Messrs. A Limited, an Indian public sector company, wants to seek advance ruling from the board for advance ruling in respect of a matter in relation to computation of total income involving a question of law relating to such computation. However, the matter is already pending before the Income Tax Appellate Tribunal ITAT as on the date of application of advance ruling, which is 12th December 2021. It cannot seek the board for advance ruling till the matter is pending before the ITAT. Now, if you see, this is also incorrect. Because if you actually look at this particular exception, which is the public sector undertaking notified by the central government, well, then for them, they can actually seek advance ruling, even if the matter is pending before ITAT. So this is also incorrect. And with this, we finish with advance ruling also. If you have any questions, uh, I'd be happy to answer them, or you can put it on the chat box, or you can put it on the portal also. But if there are no further questions, then I'd just like to skip. Okay, waiting for questions. Okay, if there are no questions, I'd just like to thank you for the session today. All the very best for the exams. And um, if you have questions, I can address them later. I'd be happy to post this slide and just share it with the team also. Thank you so much. Yes. Thank you so much. Okay, everyone, welcome back. Now, what I'll do is I will just take you through the manual and we will discuss some of the questions and I will just take you through, the concepts that are there in the manual. Just allow me a minute before I share my screen. Okay, is my screen visible?
Uh, yes, sir.
Hmm. Okay, everyone. So, I quickly wanted to come back and just share what we all discussed from the manual. So we will be now spending some time and discussing the concepts that are there in the manual, and then we will go through the end of the manual, and then we will discuss the questions that are provided there in the manual. Some of the questions were the ones that we already discussed in the slide deck, but nevertheless we'll go through all the questions again that are actually provided in the manual itself out there. So okay, so this is the introduction. This is where we discussed the arm's length principle. So this is where they actually say what exactly is the transfer price, what exactly is the arm's length principle, etc. The meaning of the arm's length principle. Now this is one of the topics that actually talks about the significance of arm's length principle. This is a topic which is theoretical in nature. Nevertheless, it talks about what exactly are the reasons that the OECD member countries, and even in India, I displayed that there is section 92 in the Indian Income Tax Act that actually talks about the arm's length principle. So what exactly are the reasons why all these nations are actually adopting the arm's length principle? Well, the first one is there has to be a parity between the multinational companies and the independent enterprises. The reason is that arm's length principle basically mimics independent enterprise behavior. So it always says that how are independent parties dealing and how are multinational dealings. That should be the same. Multinationals should actually deal in the similar manner that independent enterprises are dealing. So that is actually possible using something called as the arm's length principle. So there has to be a parity between multinational companies and independent enterprises. Then it determines the real taxable profits. When I displayed the slide deck, there was a case study that we were discussing, which basically said that, the profits were lesser because the related parties were dealing with their own whims and fancies. They were dealing at a price which was determined because of the relationship that exists between them. And that was not correct. This is the reason they apply something called as the arm's length price. So, by using something called as the arm's length price, which is how multinational enterprises are dealing, it helps them determine the real taxable profit. Then it also reduces the artificial price distortion, because obviously if ALP is not followed, multinational companies will just follow their own price, which is not the real thing, and they will artificially reduce their taxable profits. This is the reason it's important to follow something called as the arm's length price. That is the price at which multinational independent enterprises are dealing with. And finally, they say that there should be accurate measurement of economic contribution. This is, the arm's length price. It actually mimics fair market value, and this is the reason it results in multinational companies earning a return which is equal to the economic contribution, etc. Now, these are some of the practical difficulties in application of ALP. It basically says that true comparison is difficult in certain cases. We discussed, CUP in detail. We discussed the comparable uncontrolled price in detail, and this is where I told you that to get data for CUP is a very, very difficult task, and this is the reason true comparison is very, very difficult in certain cases. How do you find out the CUP for a particular transaction? How do you really find out which is the uncontrolled price, which is very, very comparable to your associated enterprise? That's a very, very difficult thing out there, and that is what it basically says here. Then it says availability of data and reliability of data. Again, just a reiteration that CUP, it's very difficult to find available data. But then obviously, if you have available data, then it's absolutely fine. Absence of comparable market price for intangible transactions. Now this is one of the problems that I discussed for profit split method also. If you are adopting something called as a profit split method, and this is applicable for intangible transactions, now looking for a comparable transaction out there, a comparable market price out there, is very difficult. Why is it difficult? Because ultimately you're talking about transactions of intangible property. The reason that they are called as intangible property is because they are unique in nature, and this is the reason comparable market price is absolutely not available there. This is absent, and this is one of the problems with ALP also. Administrative burden. Well, there is a lot of compliance which is involved. There is a lot of subjectivity in selection of comparable companies. If I feel that these are the 5 comparable companies that are applicable to my situation, the tax authorities might not feel the same. So there is subjectivity in selection of comparables. There is a reason that they say that transfer pricing is an art. It's not science. It's not a subjective. It is a subjective area, but it's also an art in itself, and that is because there is a lot of subjectivity which is involved in that kind of situation. Then there is a time lag out there. um, um, the associated enterprises, they transact today, and after that you have to justify that they are at arm's length. So this may lead to some time lag out there. Even when the documents are actually opened, it goes into scrutiny. It takes a lot of time in that. So this is the reason that there is time lag. But in spite of these particular practical difficulties, ALP is something, if you look at the arm's length price, that is something which is adopted by OECD member countries, UN member countries, and even in India, because it is actually better than not having anything. By, if there is absence of ALP, I showed you situations where there could be tax avoidance, situations. So this is the reason it's important to have something called as, ALP. Now, as I mentioned, this is Finance Act 2001. We've already discussed this. This is a situation where they basically say when transfer pricing will be applicable. Well, when there is an international transaction between associated enterprises, etc. This is the whole situation where they talk about the computation of income from an international transaction with non-residents. These are the situations that we discussed in detail. Section 92A, subsection 1. It's just, a statement here, but this is what we actually discussed in detail. You should now know that if enterprise participates directly or indirectly in management, control, and capital of another enterprise, they become associated to each other. And then they talk about these 13 instances, that we actually discussed, where they will be talking about association. Now, this is one of the areas where they actually define the term enterprise, which is provided in section 92F, subsection 3, where they actually define what exactly is an enterprise. They basically say that this is including a specified permanent establishment where you have engaged, or you propose to engage in these kind of activities. It could be production, it could be storage, supply, distribution, etc., or it could be secret formula, intangible transactions, etc., or it could be a service transaction, so services of any kinds, etc., providing loan, etc. Those are basically an enterprise. This is what we discussed, that international transaction, section 92B, and a deemed international transaction. I'd strongly suggest, this concept of deemed international transaction, I'd strongly suggest to actually go through the table, the diagram that we discussed in the slide, because that will actually make it more clear rather than just reading through, the text out here. So it's very, very important that you go through the um, um, table and the diagram that we discussed for deemed international transaction. Now, this is one of the questions for deemed international transaction. Let's try to identify what they're really trying to say with this kind of, question. Now, in this situation, they say that if A Limited, with this one, is an Indian company. Now, they have entered into an agreement for sale of product X to Mr. B, an unrelated party, and this has happened on 1st June 2024. So we are talking about A Limited, which is an Indian company, and they have an agreement to sell for product X, and they have entered into with Mr. B, which is the related party, and this is on 1st June 2024. Now, Mr. B has entered into an agreement for the sale of this product X with C Incorporation. This is a non-resident entity, and this particular entity holds 27% voting power in A Limited. Now, this is where you have to realize that if C Incorporation is the non-resident entity and it's holding 27% voting power in A Limited, well, obviously these are related enterprises, associated enterprises. How are they associated? Well, C Incorporation is holding 27% voting power in A Limited. So the voting power is more than 26%, and it's voting power. So by virtue of section 92 A 2 subsection or clause A, they are going to be related to each other. Now, Mr. B has entered into a transaction with C Incorporation, and this has happened on 30th June, 30th May 2024. Now, this is the basically transaction. So A has entered into transaction with B for sale of product X, and B has entered into transaction with C Incorporation for sale of the same product X, but this has happened before. Now, because B has entered into a transaction with an associated enterprise of A, they were trying to circumvent transfer pricing provision. This is where we'll say that the transaction between A and B is a deemed international transaction. Why is it deemed international transaction? Because A entered into transaction with B so as to circumvent transfer pricing provisions, because B already had a transaction with the associated enterprise of A Limited. This is the reason we'll say that A and B, this is also a deemed international transaction. So I do understand that A Limited and Mr. B, they are unrelated parties. They are not related to each other. But still, because they were trying to circumvent transfer pricing provisions, we'll call them a deemed international transaction. And transfer pricing provisions will be applicable to these two entities also. Now, this is where it talks about the meaning of international transaction. So this is all that I covered in the slide. You can, just go through that. And this is where they talk about section 92C, which is, the arm's length, the transfer pricing methods, the arm's length price methods. So this is what we discussed. These are the traditional methods that are displayed. These were the profit methods, and this is the other method which I mentioned was applicable, in India. So this is the CUP, method out there. Okay. So this is the illustration on, the CUP method. In the CUP method, it says that US Limited, a US company has a subsidiary, IND Limited in India. US Limited, a US company, has a subsidiary, IND Limited in India. US Limited sells computer monitors to IND Limited for resale in India. Now, this is where you have to realize, I think it's also, sometimes important to make a chart out there so as to understand the flow of, the transaction. US Limited, this is the US company. It has a subsidiary in India. This US company is actually selling monitors, computer monitors to Company Limited for resale in India. But then US Limited also sells computer monitors to CMI Limited, another computer reseller. Now it sells 50,000 computer monitors to IND Limited at 11,000 per unit, and the price fixed for CMI Limited is 10,000 per unit. The warranty in case of sale of monitors by IND Limited is handled by IND Limited. However, for sale of monitors by CMI Limited, US Limited is responsible for the warranty for 3 months. Both US Limited and IND Limited offer extended warranty at the standard rate of 1,000 per annum. On these facts, how is the assessment of IND Limited going to be affected? Now understand, what they're really trying to do is to ask you how is the assessment going to be affected. As in, what you have to do is apply a method. Now, because we were talking about CUP, it's very easy for you to know that this is maybe a question that talks about the CUP method. But then the point is, how will you understand that this actually requires a CUP method to be used if this is an independent question? Now, this is where there are two things that you have to keep in mind. The first thing is that when you make the chain diagram that I mentioned, you will understand that US Limited is selling computer monitors to, the related party, and it's also selling computer monitors to the unrelated party out here. Now, you have data available for, both. How is that available? Well, for related party it's 11,000 per unit, and for unrelated party it's 10,000 per unit. So you have data which is available for both the situations out here. So this is the reason you can actually ascertain that this could be a CUP transaction, because you have data available for unrelated party also, a comparable unrelated party. So and you should also know that this is an internal CUP which is applicable here. So this is the reason CUP will be applicable, and then you have to ascertain how CUP will be applicable. So when CUP is applicable, what you do is you actually start with unrelated party. So the sale price which is charged by US Limited to CMI Limited is 10,000 per unit. So this is what we actually start with when it comes to CUP method. Now, when it comes to CMI Limited, it is US Limited which is responsible for warranty for 3 months. So what we're going to be doing is from this particular amount, we will remove the cost of warranty, because if you look at CMI IND Limited, the warranty is handled by our IND Limited itself. But for CMI Limited, US is responsible. So what we'll do is, to make the two transactions comparable, we will remove the cost of warranty from here. So what we'll do is we'll remove the cost of warranty for 3 months, which is 1,000 per annum, multiplied by 3 by 12 to make it 3 months, which is 250. So the arm's length price should have been 9,750. Okay, that basically means that US Limited should have been charging 9,750. But what is US Limited charging? Well, they are actually charging 11,000 rupees. So what is the difference? 1250. 1250 is the difference for 1 unit. What is the difference for 50,000 units? Well, it's going to be um, 6 crores 25 lakh out there, or 6.25 crores out there, which is going to be the enhanced income. So this is going to be the amount that will be primary adjustment out there. This is the amount that will be added to their income to make it comparable. So what has happened in this particular question, just to give you a summary and a perspective, is that When it comes to COP, just start with a unrelated party, situation, and then make adjustments accordingly. You need to make the two transactions comparable. So howsoever is your related party transaction, try to do the same thing for unrelated, party also. And then you will see the difference, and that difference will be called as a primary adjustment. Now, what I'm going to do is also introduce the concept of secondary adjustment in this particular question. Now, it could ask, the question does not ask, but let's say that the question asks for the second part, which is how will you deal with secondary adjustment in this particular situation. So first thing, this is 6.25 crore. This is called as primary adjustment. The second question is, do you think secondary adjustment will be applicable in this situation? And I'm going to just post it on the chat box also so that you can, see. And I'm going to put this question onto the portal also. Okay. So the question is, do you think secondary adjustment, kind of situation will be applicable here? Well, the question is, yes, secondary adjustment will be applicable here. Why will it be applicable here? Well, because secondary adjustment is applicable where primary adjustment is more than 1 crore rupees. What will you do if secondary adjustment is applicable? Well, the point is that the Indian company should get 6.25 crore back, out here. If that amount is not remitted within a period of 90 days, well, then it will be considered as deemed loan, and there will be interest that will be chargeable to tax in the hands of the Indian company. Now, if that is not a possibility, if there is no repatriation which is made within a period of 90 days, well, then they can opt to pay an additional income tax of 20.9664%. How is 20.9664% coming? Well, it's 18% plus surcharge plus cess, etc. So that is the amount of tax. If they make that one-time tax of 20.9664%, then there will be no need for secondary adjustment, and then there will be no need for interest imputation, etc. And this will be called as the final payment of tax. And finally, there will be no deduction that will be available for that amount of secondary adjustment. This is all that you are expected to write in an examination kind of format. Now, the next method is basically the resale price method. In case of resale price method, what you have to remember is that this is applicable in case of traders and distributors, and you have to remember that there should be no value addition at the level of subsidiary company. Now, this is the cost plus method. The cost plus method is, where there will be manufacturing and contract manufacturing cases. There will be a direct and indirect cost of production, etc. This is what you have to remember. What I'd like to actually discuss in detail is the transactional net margin method. Now, the kind of question that they've given here for transactional net margin method is something that will require a lot of insight. It will give you a lot of perspective into how TNMM method comes into existence. And it will give you a lot of perspective on associated enterprises and international transaction. So what I'm going to do is now discuss, this particular question on TNMM method. So this is how the question really looks like. Let's take 2 minutes and just read through the question very, very quickly. So just read through the question, then I will just you know discuss the question in detail with you guys. Okay, so let's come back and discuss this particular question on, the TNMM method. Now, in this particular question, they talk about A incorporation having its business in Malaysia. It has advanced a loan of Malaysian dollars 1,60,000 to Andes Limited India. The book value of total assets of Andes Limited was 125 lakh. Andes Limited provides um, software backup support to Andes Incorporation. Andes Limited has spent 50,000 man hours during the financial year 24-25 for the services rendered to Andes Incorporation. The cost for Andes Limited is Malaysian dollars 75 per man hour, and they have billed Andes Incorporation at Malaysian dollars 90.75 per man hour. Now, there is also Gamma Limited in India, which has similar business model. It provides software backup support to Olive Incorporation in Malaysia. Gamma's Limited's cost of and operating profits are these. So they have actually given you direct cost, indirect cost, and operating profits. Calculate arm's length price for the transaction between Andes Limited and Andes Incorporation based on the above data of Gamma Limited using TNMM. Explain if there is any adjustment to be made to the total income of Andes Limited. Now, this question has specifically mentioned that, what method they want you to use is basically the TNMM method. So it's very easy. Transactional net margin method is, something that you need to use for the purposes of, this question. Now, but then you have to see the first part is whenever transfer pricing is applicable, the first part is whether these are associated enterprises or not. So in this particular situation, you will have to see whether Andes Incorporation and Andes India are associated enterprises or not. They have actually talked about advancing a loan of Malaysian dollar 1,60,000 rupees. Now, if you remember section 92, and I'm going to again post it on the chat box. Section 92A, subsection 2, clause C. This is the one that basically says that whenever there is, advancement of loan, it has to be 51% or more of the book value of total assets. Now, book value of total assets is given, which is 125 lakh, and you will have to see whether the loan is 1,60,000 Malaysian dollars. So the first part will be to actually convert Malaysian dollars into rupees, which is the conversion rate is provided, right here. So if you actually see, it constitutes 57 sorry, it actually constitutes 57.6% of the loan. And if you look at the law, it basically says 51% or more is what we need. So obviously these are associated transactions. Now, the second thing that you need to see is whether they are international transactions or not. In this particular question, they're talking about, they're talking about provision of software backup support, services. This is obviously an international transaction. So if you look at section 92 B, this is where they say that this is a valid international transaction. So this is an international, transaction out there. Now, what you need to do is you need to determine the operating profit margin for this particular transaction. You need to see that your related parties. Now, we've made Andes Limited and Andes Incorporation related to each other. Now, you have to see that what is the operating profit margin of this company, and then you have to compare it to the operating profit margin of the independent company. So let's see the operating profit margin. Well, you have the billing per man hour, which is this one, and the cost plus man hour is also provided here. So obviously the operating profit plus man per man hour is this one. So how do you calculate the billing? Well, the billing is provided in the question itself. They are billing at 90.75 plus man hour. So this is 90.75. The cost plus man hour is also provided in the question, which is 75. So if you just do like sales minus cost, this will give you the operating profit, which is 708. Now, what you need to do for TNMM is, as I mentioned, operating profit by cost. This, as I mentioned in the slide, is also called as profit level indicator. So this actually comes to profit, which is 708, divided by the cost, which is 3375. So you get a 21%. This is the operating margin for the transaction of software backup support by Andes Limited to Andes Incorporation. Meaning to say that your related parties, when they are transacting, they have an operating profit margin of 21%. Now you need to determine the operating profit margin of uncontrolled transaction. They've also already given you the data. They have given you that, when two independent parties, they are transacting, what is the profit margin? Well, they've given you the direct cost and the indirect cost in question. It's right here. So the cost is 600 and 200. So the total cost is 800. This is the 800 cost, and they have given you operating profits also, which is 200. So the margin is going to be 200 divided by 800 into 100, which is operating profit divided by cost. This is exactly what we did for related party also. So if you see, for related party also we did operating profit by cost, and for unrelated party also we're doing operating profit to cost. So this comes to 25%. Now, what you have to remember from an examination perspective is that whatever you're doing for related party, you have to do the same thing for unrelated party. So for related party, if you're doing operating profit by cost, you have to do the same thing, operating profit by cost, for unrelated party also. So it comes to 25%. Now, this is where you need to actually, compare. This is where you need to compute the arm's length price out there. And how will you do that? Well, the cost for Andes Limited was, 75 um, Malaysian dollars. You have to convert it to INR, which is 3375. Now, you add the operating profit margin at the rate of 25%. 25% is what should have been the arm's length price, what should have been the price out there. So you add the profit margin of 8,743 out there, and then the arm's length price per man hour is this one. Now the total is 21 500, but less the amount which is actually billed is 20. So this is the adjustment which is made to the total income, which is 67 lakh 50,000 out there. This is the adjustment that should be made to the income of Andes Limited. So this is how you need to target a question which deals with TNMM method. Just a summary, what you need to do is calculate the arm's length markup using for related party. Do the same thing for unrelated party, compare them both, and you will know the arm's length adjustment to be made. Now in this particular situation, because the arm's length adjustment is 67 lakh 50,000, which is less than 1 crore rupees, no secondary adjustment is required. Now, this is where they talk about, as I mentioned, about multiple year data, etc. This is, what you need to uh, do. And I'm going to just go to the next part that we discussed, which is the safe harbor rules. And then this is the part that actually deals with something called as APA. I did display the fee, etc., the withdrawal of application. I think it's you can read through the law here, but the summary is actually provided in the slide deck, so you can actually read through the slide deck for that particular summary. And then it talks about the rollback provisions right there. Now, these are, the FAQs that were given by the CBDT, that were issued by the CBDT for these particular, rules. So you can just go through these particular rules, again. Then they talk about primary adjustment and secondary adjustment, etc. The form of secondary adjustment that is used in India, as I mentioned, is deemed loan. So this is all that is provided here. These are the timelines that we've discussed, etc. This is one of the questions that actually talks about primary adjustment and secondary adjustment. So what we can do is we can just go through this particular question, illustration 6, which actually deals with secondary adjustment. So again, just take a minute and read through this particular question, and then we'll discuss it. Okay, so let's get back to this particular question. This question talks about secondary adjustment, and it talks about on 1st April 2024, PQR Limited, an Indian company, they advanced a loan of 6 crore to XYZ Incorporation, a company resident in Singapore. Now, as on the date of the loan, the book value of total assets in the book of XYZ Incorporation was 10 crores. XYZ Incorporation paid the entire loan along with interest thereon on 31st August 2024. During the financial year 2024-25, PQR Limited also entered into an agreement with XYZ Incorporation to provide 20,000 medical equipments at a cost of 74 per unit. The assessing officer treats them as associated enterprises and wants to recompute the income of PQR Limited at an arm's length price. You are required to answer the following questions. So these are the questions that we need to answer, the three questions. First, would PQR Limited and XYZ Incorporation be treated as AEs for the purposes of transfer pricing? Second, compute the arm's length price of PQR Limited, which sells the equipment at the rate of 9,000 per unit to Y Limited and 9,500 per unit to X LLP. Both of them are unrelated parties, and PQR is not a wholesale dealer. What are the options available to PQR Limited in respect of such increase in transfer price by income tax authorities if PQR Limited accepts such transfer price? So what you have to do in this particular question is, to go step by step. This is exactly what we were discussing. The first thing is for transfer pricing to be applicable, whether entities are associated. Second, if yes, you have to compute the arm's length price. And third, you have to see into secondary adjustment issues. So the first thing is, do you think PQR Limited and XYZ Incorporation can be treated as associated enterprises? Well, this is where if you actually see and look at the question, they talk about advancing of loan. Now, the moment you see these terminologies, advancing of loan, you know that there is section 92A, subsection 2, clause C that will be applicable. Why clause C? Well, clause C says that two entities will be associated if one entity gives a loan to the other entity of 51% or more of the book value of total assets. As I mentioned before, in questions, you have to take care of a lot of things for provision of loan. First, you have to see that the threshold is 51% or more. So at 51%, they can become associated. More than 51%, obviously, they are associated. The second thing that you have to take care of is that they are talking about book value of total assets. They're not talking about, the law does not say market value or fair market value, etc. of total assets. They are talking about book value of total assets. So it says two enterprises will be associated if the law is provided here. If one enterprise constitutes not less than 51% of the book value of total assets at any time during the previous year. Now, in this particular situation, PQR has given a loan of 6 crores and the book value of the total assets is 10 crore. So that basically means that this is 60% out there. Now, because this is 60% more than 51%, they will be deemed to be associated enterprises. So this is what you have to take care. So one, they are associated enterprises for sure. Now, when it comes to an examination format, it's important for you to not just make the calculation, sorry, not just make the calculation, just say that 6 crores and divided by 10 crores and say that this is 60%, which is more than 51%. It's important for you to provide that this is what we are looking at, this is the law that we are actually looking at. So now they are associated. Now the thing is that when it comes to, the question says that when it comes to the cost of providing medical equipments, it's 7,400 per unit. So related party transaction price is 7,400 per unit. Let's see what is the price which is the CUP price. Well, this is the information that you have to use for the purposes of CUP price. Why this particular information? This information will tell you that one CUP will be applicable for calculating the arm's length price. Why CUP will be applicable? Well, note the words. It says sells the same equipment. So when it says sells the same equipment, and this is to unrelated parties, you know that there is data which is available for unrelated parties. And this is the reason CUP, which is the comparable uncontrolled price method, that will actually be applicable. So this is the reason CUP will be applicable. Now, what happens when CUP is applicable and there are two comparables that are available? Well, what you do is you use the arithmetic mean method. Why are we using arithmetic mean and we're not using arm's length range? Well, that is because, go back to the slide deck, I mentioned that when you have comparables which are less than 6, so 2 comparable, 3 comparable, 4 comparable, 5 comparables, this is what I mentioned. Till 5 comparables, you have to use something called as arithmetic mean, and after that you use interquartile range. So because we have two comparables available here, we use arithmetic mean. So when we use arithmetic mean, this is 9,000 plus 9,500 divided by 2. This will actually give us an arm's length price of 92.50. What we've done is we've just calculated the arithmetic mean right here. So now arm's length price is 92.50. What is the price that they have dealt with? What is the related party price? Well, it's 7,400 per unit. So this is the reason there is a difference out there. What is the difference? 92.50 less 7,400. And this is basically the difference, which is 1850. Now, 1850 is the difference for 1 unit. What is the difference for 20,000 units? Well, it comes to 3.7 crores. That basically means that they should have dealt at they should have transacted at 92.50, but because they were related parties, they thought that we'll transact at 7,400. This is the reason there should be a transfer pricing adjustment of 3.7 crores. Now, because this is a transfer pricing adjustment, which is also called as a primary adjustment. Now, if you go back to the law, I mentioned that, secondary adjustment situations are applicable where primary adjustments is, more than 1 crore rupees. Now, because this is more than 1 crore rupees, it is 3.7 crore rupees. Obviously, secondary adjustment will be applicable. And the primary adjustment is also in respect of assessment year 25-26, which is obviously more than, which is after 2016-17. This is the reason secondary adjustment will be applicable. It's important for you to just mention all these points in the exam. First, mention that there is primary adjustment which is accepted. Second, mention that primary adjustment is more than 1 crore. And third, mention that primary adjustment is for assessment year 25-26. And this is the reason secondary adjustment will be applicable. Now, then you have to mention that 3.7 crore should be remitted to India within a period of 90 days. What if it is not remitted? We'll consider it as a deemed loan and interest will be imputed. Alternatively, they can pay a tax at the rate of 90.664%. And this is like a one-time tax payment. No deduction will be allowed from any of the provisions of the Income Tax Act. And this is all that you have to mention for the purposes of this particular, question. So, yes. So I think this is a very full-fledged question because it will test AEs. This will test, arm's length price, and it also tests the concept of primary and secondary adjustment. Now, the next concept which is provided in the manual is the concept of transfer pricing documentation. This is what we've done in detail. So you have to remember that there is something called as the accountant's report. There is something called as Form 3CEB, TP study, and then there is something called as CBCR, master file and local file. I'd suggest that I've mentioned some questions in the slide deck relating to OECD BEPS Action Plan 13 CBCR, which were asked time and again. So go back and read through those particular questions. They basically talk about what are the benefits of OECD BEPS Action Plan 13? What are the benefits of CBCR? What are the benefits of coming up with the 3-tier documentation structure, etc.? So go and just read through all those questions. Obviously, the slide deck also mentions about the thresholds and all these things there. So I just suggest that read through here and then go through the questions and the summary in the slide deck. Now, this is, the manual that talks about the penalty to where there is failure to comply with the transfer pricing, provisions. There are all these, sections out there. Section 270A, subsection 9 talks about the failure to report any international transaction or deemed international transaction. This is called as misreporting of income, and there is a penalty of 200% of tax payable. Now, when you don't furnish the accountant's report is also called as Form 3CEB. Remember that there is a penalty of 1 lakh rupees. Then when the assessing officer calls for information and that is actually not furnished, there is a penalty of 2% of the value of international transaction. Then if you don't have the documentation which is provided in section 92D, if you don't keep and maintain that particular documentation, TP study, etc., there is a penalty there also, 2%. If you don't report international transaction which is required to be reported, or if you just furnish incorrect information and maintain incorrect information, there is a penalty of 2% of the value of international transaction. Now, this is, as I mentioned, OECD Action Plan 13, which talks about the 3-tier documentation structure. These are, the advantages that I mentioned. And these are the objectives and the reporting requirements of CBCR. I have just mentioned this in a tabular format in the slide deck, so you can go through that. The slide, as we discussed, also talks about the threshold, which is 6,400 crores, and it mentions about the time limit, etc. So you can go through that. Okay, now this is the segment that talks about specified domestic transactions. Now, there is also a situation in India wherein transfer pricing is also applicable, to domestic transactions. So, two entities in India can also be subject to domestic transfer pricing, provisions. This is called as specified domestic transaction. This is applicable where we have, a unit, let's say a unit in India which is claiming tax deductions, claiming tax exemptions, and then they are dealing with another unit in India. If they have transactions, tax holiday unit and a non-tax holiday unit, then that is actually subject to specified domestic, transaction. Now, a lot of things to specified domestic transaction. One, this is a provision which is coming from Section 92BA. Section 92BA talks about a host of transaction. There was a time that any two entities in India were subject to a specified domestic transaction if the threshold was more than 5 crores. But now they have just made a lot of changes out there. Now they have deleted the concept of 48(2)(b) from specified domestic transaction, and they have just narrowed the scope of specified domestic transaction. You have to note two things. Now, the threshold is 20 crores, it's not 5 crores, and they have deleted 48(2)(b) provision from specified domestic transaction. So they basically say that if you have any unit which is doing a transaction which is section 80A, which is inter-unit transfer of goods and services, and if there is a ATIA 10 transaction, or if there is a 115 BAB kind of transaction, or if there is a cooperative society which is 115 BAE kind of transaction, well then if you add up all these transactions and the threshold is more than 20 crore rupees in 1 year, then the provision of specified domestic transaction is applicable. Meaning to say, domestic transfer pricing provisions will be applicable. And domestic transfer pricing provisions, they run in similar manner. You'll have to do all the benchmarking exercises. You'll have to maintain a TP study. You'll have to do Form 3CEB also for the purposes of these, transactions. These are all the, penalty provisions out there, and the applicability of provisions to specified domestic transactions. As I mentioned, the rules are exactly the same. So, accountants report section 92E, that will also be required to be furnished in case of specified domestic transaction. And when it comes to TP study, this is section 92D TP study. This will also be required to be maintained for specified domestic transaction. And the threshold is also the same, which is 1 crore rupees. This is safe harbor rules that we've, discussed. Okay, and this is anti-avoidance measures in respect of transactions with persons located in notified jurisdictional areas. So this is just a small, clarification where there are specified and notified jurisdictional areas, where there is the objective is avoidance of tax avoidance, just to make sure that those do not happen. So you can go through that. Okay, this is an important concept, which is limitation of interest deduction. This is the thin capitalization rules that we were talking about, that there is thin capitalization which is applicable. So a lot of multinational companies, they have excessive debt in their structure, and what they try to do is minimize their tax liability or lower their tax liability by claiming those interest deductions. This is the reason they have come up with OECD BEPS Action Plan 4. And what they have done is, in India, they've incorporated the recommendations of OECD BEPS Action Plan 4 in section 94B. This is also called as interest limitation rules or thin capitalization rules. As I mentioned, the threshold again for interest is 1 crore. So you can actually go through the table that I have mentioned in the slide deck. The table is very concise, and it will just help you remember the provisions in a concise manner. So this is the table. Okay, so what we can do is just go through this particular example, which basically talks about interest limitation rules. So I'd suggest that just take 2 minutes and read through this particular example. Illustration 9 is what we will be discussing. So just take 2 minutes and read through illustration 9. Okay, so let's discuss illustration 9. This talks about ND Limited. This is an Indian company and they have borrowed 90 crores on 1st April 2024 from TM Incorporation, a company incorporated in London. This is at an interest rate of 10% per annum. The said loan is repayable over a period of 5 years, and this loan is guaranteed by TY Incorporation, incorporated in UK. Messrs. TD Incorporation, a non-resident, holds shares carrying 40% or more, 40% of voting power, both in ND Limited and Messrs. TY Incorporation. The net profit of Messrs. ND Limited for previous year 24-25 was 11 crores after debiting the above interest, depreciation of 5 crore and income tax of 4 crore. Calculate the amount of interest to be allowed, which is to be claimed under PGBP in computation of Messrs. ND Limited, giving appropriate reasons, and also explain allowability of such disallowed interest, if any. Now, a lot of things here. How do you approach a question relating to this? Well, the first thing that you have to do is make a line diagram or make a chart. That will actually make things easier. So you can actually start with ND because there are a lot of terminologies. There are a lot of entities that are here. So what I'd suggest is that you make a chart out here. ND Limited. This is the Indian company. They have borrowed from TM Incorporation, and there is a guaranteed transaction also. So the first thing is whether there are whether there are associated entities or not. Well, the first thing that you have to establish here is that if it is an Indian company which is the borrower, just see whether there is an Indian company which is the borrower and they incur any expense and the interest is more than 1 crore rupees, well, then you'll have to make sure that section 94B is applicable. Then you have to make sure that this percent, that there is a threshold of excess interest out there and that will be allowed or not allowed in this particular situation. And then you'll have to also look at associated entities in this particular situation. Since you see that TD Incorporation, it holds 40% voting power. Obviously it's more than 26% voting power, and they hold it both in ND Limited and TY Incorporation. You know that ND Limited and TY Incorporation will be related to each other. Remember, same person holding 40% here and 40% here. So these two entities will become associated to each other. Now the loan is taken by ND Limited, 90 crores, and it is guaranteed by another entity out there. Now, because there is guarantee which is available, there is another associated entity out here. So what you do is, how do you know that there will be this particular amount of interest that will be disallowed in this particular situation? Well, what you do is you start with net profit. Now, if you see, net profit is 11 crores out here. So what you do is you start with the net profit of Messrs ND Limited for the previous year 24-25, which is 11 crores. Now this is 11 crores. Now if you actually see, this 11 crores is after debiting interest, depreciation and income tax. This is after, debiting. So what you do is you add back that interest. So interest is 90 crores of 10%. Where is it mentioned? Well, it's mentioned here, 90 crores at the rate of 10%. So you debit so you add the interest which is already debited, which is 9 crore, add the depreciation which is 5 crore, and add the income tax which is 4 crore. Why did we do that? Because we want EBITDA. We want earnings before interest, tax, depreciation, amortization. Before we want that. But in this particular situation, the 11 crore of net profit was after. So to make it before, we added all these, things. So we got the interest before, earnings before interest, tax, depreciation, and amortization as 29 crore. Now, what is the excess interest that will be disallowed? Well, it will be interest which is paid or payable, which is 9 crores, or it will be total interest paid in excess of 30% of EBITDA. What is the total interest paid? It is 9 crore minus 30% of EBITDA, 30% of 29 crores, which is this. So you will actually get 30 lakhs. So the law says, what is the excess interest that will be disallowed? Well, it will be this amount, total interest, this, or it will be interest paid or payable, whichever is lower. So it's going to be 0.30 or 9 crore, whichever is lower. So obviously it's going to be 0.30. So what they've actually done is that this particular amount, 0.30, will be disallowed. So what is the interest? Total interest is 9 crore. What will be disallowed? It will be 0.30 that will be disallowed for deduction. So what will be the allowed amount under PGBP? Well, it will be 8.7 crores that will be allowed. So this is how you need to address the question. Now, when it comes to interest limitation deduction, just as a summary, what is important is that just see, first calculate EBITDA unless it is available in the question. If it is not available, then you have to calculate earnings before interest, tax, deduction, amortization. Okay. So that is what you have to take. So you have to take two things: interest, which is paid or payable, which is 9 crores here, or interest minus 30% of EBITDA, which is interest 9 crores minus 30% of EBITDA, this amount. So you have to do this amount or this amount, whichever is lower. This will be disallowed interest. Disallowed interest, which is 30 lakhs, it can be carried forward to subsequent assessment year, and it would be allowed as deduction against profit and gains to the extent of allowable interest, obviously. So this can be carried forward. So yeah. So this was interest limitation deductions. Aparna ma'am, do you want me to cover anything else? Since
I think you have covered now the 94B also and 92CE also, and with the illustrations you have covered. Yeah, I think you have make them revise the provisions thoroughly, and it's really a very important chapter because transfer pricing carrying around minimum 6 to 12 marks questions, and it's really really very important and one of the practicing area for the chartered accountants. And hopefully, yeah, definitely, Kriti ma'am, you have already covered it in detail. The so I
what I
think we
can do
can.
is I have my slide deck, which I think I haven't shared, with anyone. Um, so what I can do is probably share it with you, and you can share it with everyone because, I was actually taking them through questions from past papers, transfer pricing questions for all these
Yeah, yeah.
topics. So you can share it with them,
Mm.
and, they can just revise through that
Yeah,
also.
we can upload it as a notes, as an assignment, on the portal.
Okay,
So either you can do or I can do, because one login ID we have given you. So there you can upload these and assignments in your thing.
I'll do that. I'll do that right
Yeah,
away. I'll
they
just
can refer it from there. Yeah, yeah,
ठीक है
yeah,
ठीक है ठीक
yeah.
है
That's great. Yeah.
Okay.
So yeah, we can wind up the session. Yeah.
Okay. Thank you so much,
Mhm.
everyone. If you have any questions, right now I'm just available. You can post it on the chat or you can put it on the portal still. I can wait and look at the questions there. Yeah. Otherwise, thank you so much, for this. I hope you were able to understand, the concepts, and all the very best for the exam. Sir, I think we can wait for a minute to see if there are any questions. Hmm. Okay, everyone, if there are no questions, we'll sign out for today. Thank you so much, and all the very best for the exams. Now I will be uploading the slide deck on the portal, so you can actually go through the provisions and the questions there. If you have still questions, you can just post them there, and I'll go through them. Thank you so much. Thank you.